What exactly is happening in the stock market? Join me as I dive into the chaos of the stock market and figure out what's really going on. The stock market is one of the most widely followed and influential financial systems in the world, affecting economies, business, and individual investors alike. Understanding what's happening in the stock market is crucial for making informed investment decisions. We are living in a time of great uncertainty, and the stock market is reflecting that. Volatility has been in the rise, with stocks swinging widely in response to changing market conditions. This unpredictability is making it tough for investors to get a clear road on the market. And as a result of that, many are finding it difficult to make confident investment decisions. Whether you're a seasoned pro or just starting out, the current market climate is certainly keeping everyone in their toes. Without wasting much time, let's get right into this video. The Nigerian exchange has delivered a strong year-to-date gains, with recent summaries showing double-digit YTD returns and large capitalization gains driving overall market strength. BFD Group is trading around 11 naira per share after a big decline from its 52-week highs as at when this video was recorded. The company reports improved profits, but the share price remains depressed. USC of Nigeria is trading in the 66 naira to 73 naira region recently, after a strong run in the year and some short-term pullbacks. These prices are what these companies are trading at as at when recording this video. Nvidia reported huge growth in its latest fiscal quarter, tens of billions in revenue driven by AI demand, while at the same time facing fresh regulatory scrutiny from China. Based on what's happening in the stock market right now, we'll be looking at the winners, the losers, and the stocks that have been stuck in neutral. I will cover examples from the Nigerian market in regard to VFD Group and USCN, and from the US market is Nvidia and Hims and Hers. I will explain why each stock is behaving the way it is, fundamentals, macro regulations, sentiments, and technicals. I will also show you what to watch next and how to avoid common beginner mistakes. Quick one here: if you're new to investing or building a portfolio, we run a YouTube community WhatsApp group where I share weekly breakdowns, earnings highlights, and red flag alerts so new investors don't make costly mistakes. Link is in the description and pinned comments. Let me break the market context and what the big picture looks like. Markets move for a handful of reasons, and the same categories repeat, whether you're looking at Lagos or New York. I will walk you through them and then apply them to the four stocks. The first reason is macro environment. These include interest rates, inflation, FX, and fiscal policy. If rates go up, high growth equities usually drop because future earnings get discounted more. If inflation spikes, companies with tight margins get squeezed. The second reason is sector trends like technology, commodities, financials, and consumer staples. Right now, AI and semiconductors are the headline sectors in the US, while in Nigeria, industrials, consumer, and financials respond strongly to FX and power costs. And the third reason is company fundamentals, which we have revenue, margins, debt, guidance. Earnings beats or misses are immediate catalysts. The fourth reason is regulation and geopolitics. It includes trade restrictions, fines, policy changes. I'll show you how that's pushing Nvidia's price and why Chinese regulatory moves matter. And the last reason is market sentiment and technicals, like momentum, volume, and investor psychology. Sometimes stocks move because people expect them to move, not because numbers change that day. From here, let's dive into Nigerian exchange. The Nigerian exchange has shown meaningful YTD gains and increased trading activity in recent weeks, with market capitalization around 88 to 89 trillion naira and improved turnover on several trading days. Why that matters is the rising Nigeria exchange headline number doesn't mean every stock is up. Often a handful of large winners lift the index while many stocks lag. That's the pattern we are seeing. Big caps drive headlines, mid and small caps lag, and sector rotation happens fast. If you don't know, FX, oil and FX remittances, interest rate policy, domestic liquidity, and foreign investor flows are what moves NGX. When the naira is volatile, import-heavy companies feel it immediately. And when the CBN changes policy, bank stocks and financials price it in quickly. For consumer staples and industrials, energy costs and local demand matter most. So at this point, let's look at what's happening in the market with VFD Group alongside my researched case study. VFD Group is one of the more interesting and confusing stories on the NGX. On paper, the company reports profits and has shown improvements, but the market price is still depressed, trading around 11 naira per share after a major decline. As for VFD Group, I have four analysis to give in respect to their stock behavior. The first is what the numbers say. Revenue trailing 12 months was around 76 billion naira, Net income roughly 8 billion naira trailing 12 months. Market cap around 83 billion naira. Earnings per share and price to earning ratio show the company is not trading at astronomical multiples, but the share price collapsed from its 52-week highs. The second analysis is what the management reported. VFD announced profit turnaround, paid dividends, and issued bonus shares after reporting profits for 2024. But their corporate actions included capital raises/rights issues which diluted investors, and that's a common reason share price can lag even when profits improve. The third analysis is why the market punished VFD Group. There are 4 reasons why the market punished VFD. Let's name them ABCD. A was dilution and capital raises. Rights issues reduced per share ownership and dampened price reaction. B, sentiment and momentum. After big sell-offs, investors need confidence to return, and improved earnings alone may not restore that confidence. C, macro headwinds. Inflation and higher interest rates increase financing costs, while electricity/diesel costs in Nigeria add operating pressure. D, liquidity and investor mix. If retail holders dominate and stop-loss selling happens, price can fall quickly and remain depressed until institutional interest returns. The fourth analysis is why VFD could recover. Profitability is real if management maintains margins and stop diluting shareholders while growing revenue. The valuation gap could close. Potential catalysts are consistent dividend, additional profitable quarters, and reduced reliance on rights issues. Despite all these analyses, here's my take on VFD. If I were you who own VFD share, I would review the company's recent disclosures. How much did they dilute? What are the next financing needs? If you're considering VFD, don't buy just because the chart looks cheap. Buy because the business shows sustained cash flow and management isn't likely to dilute again. The second stock to look at is UAC of Nigeria. UACN is a classic diversified industrial Nigerian story. Strong returns earlier in the year and short-term pullbacks as investors digest valuation and macro data. The stock has traded in the 66 naira to 73 naira range recently with a 52-week high above 100 naira. Looking from fundamental strengths, UACN owns brands and operating businesses with tangible revenue from food, paints, property. In many cases, these businesses benefit when local demand recovers. The question that needs urgent answer about UACN is why the stock pulled back/why it could stagnate. One of them is valuation relating risk. After a sharp run, some investors take profits. The second is input cost pressure from raw materials, power, logistics, and so on. And the third reason is FX exposure for import-dependent inputs. A weakening naira or import cost spike can hit margins. Here's what to monitor closely on UACN if you own their shares. Watch UACN's next earnings call, guidance, and any management comments on input inflation. Also track sector news. Food and paints are sensitive to commodity prices. Let me give you this quick tip. When you read the UACN balance sheet, focus on the working capital and inventory because big swings there often translate into short-term volatility. The next stock we should look at is Nvidia. That's for the US market case study. Nvidia is the most important single stock for anyone following AI and semiconductors. Their latest quarterly report shows enormous scale, tens of billions of dollars in revenue, driven largely by data center and AI demand. Their recent quarter highlights on revenue broke records, identifies data center and Blackwell product lines, showed strong sequential growth. Nvidia's business is benefiting directly from enterprises and cloud providers building AI workloads. The catalysts for upside include AI adoption at large scale, massive demand for GPUs for training and inference, and the second one is enterprise spending and cloud provider orders. Let's take a look at the regulatory risk and China slide and why the stock can be volatile even with strong earnings. The regulatory risk shows at the same time Chinese regulators have announced a preliminary probe alleging antitrust violations tied to earlier acquisitions and conditional business practices that has implications for Nvidia's ability to sell into China and could temporarily reduce revenue from that market. While the stock can be volatile even with strong earnings because high expectations mean even small misses in guidance can cause big price swings. Also, geopolitical trade policy, which is the export controls, can reduce addressable market from the near term. The fourth stock is Hims and Hers. Hims and Hers is a fast-growth telehealth and consumer health company. It's a narrative stock that subscribers, product expansion, and recurring revenue matter. That said, Hims has seen big gains, and these gains come with higher volatility if growth or margins slow. You need to know these 3 things about Hims and Hers: why it's up, why it's risky/pullbacks, and investor checklist for HIMSS. It's all because of expansion into new categories, recurring subscription model, and strong marketing that drives high consumer acquisition. Why it's risky/pullbacks happen because competition, regulatory scrutiny around drug categories, and dependence on marketing spend to acquire customers. And the third thing to look out for this talk is investor checklist. Think subscriber growth rates, gross margin trends, new product launches success rates, impact of any FDA guidance or industry regulation. I think with this one analysis I just gave, using four stocks as example, you now have a clue why the stock market is a bit stagnated for some weeks now. If you found value from this video, take a moment to smash the like button, drop your comments, and subscribe to the channel if you're watching on YouTube. Use the WhatsApp group link to join my YouTube community WhatsApp group if you need my guidance. Join right now because it is limited in time and space. Thanks for watching. Until next time, invest wisely and stay consistent.